Welcome back to the deep dive. What a quarter it's been for Rogers Communications. Seriously. This isn't just about the financial numbers, although, yeah, they're compelling. It's really about these seismic shifts, strategic moves that could genuinely redefine Canada's communications and, well, entertainment landscape. For years to come, you know we love a challenge, and today, yeah, we're diving deep into Rogers' Q2 2025 results.
That's right. It's a big one. We're going to unpack the key financial highlights first, then explore those huge strategic investments that closed. I mean, the deleveraging move was massive.
And becoming a majority owner of MLSE, that's iconic.
Exactly. And then we also need to shine a light on a pretty crucial regulatory challenge that Rogers is grappling with right now.
Okay, so our mission here, as always, pretty simple. Cut through the noise, give you the most important nuggets, the key takeaways, and connect those dots so you walk away feeling, truly in the know. All right, let's get into it. We've got a lot to cover. Let's peel back the layers, maybe start with the bedrock, the financial performance this quarter.
Sounds good. So overall, Rogers delivered strong operating results in Q2. Pretty solid.
Yeah.
They saw positive revenue and EBITDA growth across all their main businesses, wireless, cable, and media.
All three.
Okay.
Yeah.
And on a consolidated level, total service revenue and adjusted EBITDA, they both grew by 2% year over year.
2%. Okay,
Yeah.
steady growth. But what really jumps out, at least to me, is the free cash flow figure, a 39% increase, reaching $925 million. That feels significant.
Oh, absolutely. That's a huge number.
Why is that specific metric, free cash flow, so important for a company like Rogers, beyond just, the impressive percentage jump?
Yeah, great question. Free cash flow is really like the lifeblood of a company, right? Seeing such a significant jump signals that Rogers is generating cash very efficiently from its core operations, like really efficiently. And that gives them immense flexibility for future investments, paying down debt, maybe even shareholder returns down the line. It's a true measure of that underlying financial health. It shows that, while other numbers might bounce around a bit, the company's ability to just generate cash from its day-to-day business is really strong, robust.
I see. Okay. So underlying strength there. And I did notice, looking through the report, a reported decrease in net income, but you mentioned it's important to understand the context for that one.
Exactly. Yeah, you got to look behind the headline number there. That decrease was primarily due to higher costs related to restructuring, acquisitions, some other one-time things.
Oh, okay. One-offs.
Precisely. It doesn't reflect, a downturn in their core business performance at all. The underlying operations, like we just said with free cash flow, they look remarkably solid.
Right. Got it. So beyond those solid financials, this quarter was really defined by these, bold strategic plays, stuff that's going to reshape Rogers' future. And top of the list has to be that incredibly swift debt reduction, right? Especially after swallowing Shaw. That was a huge focus for them.
It absolutely was.
Sure.
And they delivered. Rogers ended Q2 at 3.6 times leverage, which brings their debt ratio very, very close to where it was before the Shaw deal even happened.
Wow. And the speed.
That's what's really impressive. They did this about 9 months ahead of their initial plan.
9 months. That's quick for that kind of deleveraging after such a big deal. What were the key factors? How did they speed that up so much?
Well, it was mainly driven by closing that huge $7 billion equity investment. This involved Blackstone, big global investment firm, and some leading Canadian institutional investors. They acquired a minority stake in parts of Rogers' wireless network infrastructure, specifically something called Backhaul Network Services, Inc., or BNSI.
Okay, BNSI. And just quickly, for folks listening, what exactly is backhaul in this context? Like, what part of the network is that?
Good point. Yeah, BNSI is essentially the plumbing. It's the infrastructure that carries all the wireless traffic from the cell towers back to the main core network.
Gotcha. The digital highway.
Exactly. It's the digital highway for
Yeah.
their mobile data. And what's kind of fascinating here is the financial mechanics. By selling off a minority stake in this really critical asset, Rogers pulled in a massive $7 billion in cash,
Right.
which let them pay down debt super quickly, all while they still control that essential infrastructure and the cost to Rogers. They expect to distribute about $400 million a year to the Blackstone Fund for the first 5 years. That works out to an effective cost of roughly 6.25%.
And that $400 million distribution, that's already factored into their free cash flow number.
Yes, exactly. That's included in the free cash flow calculation. So it's a pretty clever way, really,
Yeah.
to monetize that infrastructure without losing strategic control.
Okay, very interesting structure. And that wasn't the only massive headline, was it? Rogers also made huge waves, becoming a sports and media powerhouse. The MLSE acquisition. I mean, Maple Leaf Sports and Entertainment. That's enormous in Canada.
It truly is. A real giant.
Okay.
Rogers, if you go the 75% majority owner of MLSE,
Mm-hmm.
they bought Bill's 37.5% stake
Mm-hmm.
for $4.7 billion. That was effective July 1st, 2025.
Right after the quarter ended, technically, but the deal closed.
Exactly. And this deal brings this just world-class collection of Toronto sports teams under Rogers' majority control. You've got the Maple Leafs in the NHL, the Raptors in the NBA, Toronto FC and MLS, the Argonauts in the CFL,
Yeah, big leagues.
plus the real estate that goes with it, like Scotiabank Arena. It's a huge portfolio.
So, okay, what does this all mean? For Rogers, obviously, but maybe more importantly for you, the Canadian consumer, the sports fan. How does this change things?
Well, financially, MLSE's results are now going to be consolidated into Rogers' media segment. That starts in Q3. And Rogers put out some estimates. They figured their pro forma 2025 media revenue, like if MLSE had been in for the whole year.
Right, the hypothetical full year.
Yeah, that would be around $3.9 billion, with EBITDA at $250 million. And the company now estimates the total value of all its sports and media assets actually exceeds $15 billion. That's a huge number.
15 billion, wow.
And they're openly saying they're committed to unlocking this unrecognized value for shareholders.
Which sounds like code for an asset. They think it's worth even more, or they can make it perform better.
Probably a bit of both.
Yeah.
It suggests they see significant untapped potential in these assets.
Yeah.
How they'll unlock it. Well, they haven't quantified it yet, but they do anticipate future revenue and cost synergies.
Synergy, so maybe influencing bundled services, different content offerings for Rogers customers down the line.
That's definitely a possibility. Could impact what you see offered as a consumer, for sure.
All right, fascinating stuff on the strategic front. Let's maybe drill down a bit into the core business segments, the engines that keep Rogers running day to day. Wireless, cable, and media. How did each of those actually perform in Q2?
Okay, let's break it down. In wireless, they reported 1% growth, both in service revenue and adjusted EBITDA. Pretty steady. They added 61,000 total subscribers. That includes 35,000 post-paid additions. Those are the valuable monthly contract customer.
And churn looked good too.
Yeah, churn improved, down to 1.00%. That's very strong, means customers are sticking around.
Okay, but I'm seeing here ARPU. Average revenue per user, that was down 3% to $55.45. For a telecom, that's like a key metric, right?
Yeah.
A bellwether.
Right.
How much of a real concern is that for Rogers in this, super competitive market? And what's their backup plan if the current strategies don't quite stop that slide?
That's a sharp observation. Yeah, ARPU pressure is definitely something they're watching. They attribute the decline mainly to, well, competitive intensity. It's a tough market out there. And also reduced outbound roaming revenue. Apparently, less travel to the U.S. is still having an impact.
Okay, so what's the plan to fight that pressure?
Their stated strategy includes simplified tier plans, trying to reduce heavy promotional activity, new travel passes to maybe capture some roaming back. And they're also really pushing a multi-line discount strategy.
Get more phones on one account.
Exactly. The idea is to drive incremental service revenue by encouraging more lines per account, even if, as they admit, it's dilutive to ARPU on a per-user basis. More users, more lines overall, hopefully offsets the lower per-line revenue.
So the contingency seems to be volume, bank on scale.
It seems that way. Focus heavily on getting higher subscriber numbers, more lines per account. They're betting that scale will deliver the overall revenue growth, even if that individual ARPU number dips a bit.
Okay, we'll have to watch how that plays out. Let's shift gears to cable. Now, this segment is actually celebrating a return to revenue growth after, well, some tougher periods, right? That feels significant.
Yes, definitely a positive story there. Cable service revenue was up 1%, and adjusted EBITDA was up 3%. Better margin expansion, too. They also saw strong retail internet net additions, 26,000. People are still signing up for their internet.
And you mentioned margin improvement.
Yeah, that's particularly notable. The cable adjusted EBITDA margin increased by 150 basis points. It's up to 58%.
58% margin in cable. That's pretty hefty. How'd they manage that?
They attribute it mainly to ongoing cost efficiency initiatives. But it's likely a combination of factors. Consistent internet subscriber growth helps. Disciplined management of the customer base, probably some modest price increases here and there. Plus, the rollout of their advanced offerings like Rogers Xfinity for TV and, importantly, Wi-Fi 7 for internet.
Right, the new tech.
And they also mentioned getting good traction and expansion in the small and mid-sized business segment. That's clearly a focus area for them in cable now.
Okay. And bringing us home on the core segments, media. Before the MLS consolidation, how did the existing media business do?
Media had a really strong quarter, actually.
Mm.
Saw 10% revenue growth.
10%. What drove that?
Primarily, successful NHL playoffs, they own Sportsnet, of course, and increased revenue from the Toronto Blue Jays. Plus, they launched that new suite of Warner Bros. Discovery channels in Canada.
Yes. The Max replacement.
Kind of. All that contributed to media EBITDA being up $5 million for the quarter. It really highlights the power of live sports and new content partnerships.
Definitely. Okay, so cool businesses seem generally solid, some pressures in wireless ARPU, but growth overall. Well, let's talk about the future, because Rogers isn't just managing what they have, right? They're investing pretty heavily in innovation, connectivity.
Absolutely. They highlighted some pretty groundbreaking network initiatives in their results. Most notably, I think, was the launch of satellite-to-mobile texting.
Okay, yeah, I saw that headline. This is where it gets really impactful for Canadians, potentially. This isn't just like a fancy new feature for tech geeks, right? It sounds like it could be genuinely life-changing, especially for people in remote or rural areas.
It truly could be. Rogers is the first and currently only wireless provider in Canada offering this service. And it's critical for a country as vast as ours. You know,
Huge landmass, lots of spotty coverage.
exactly.
Yeah.
This service apparently covers 2.5 times more territory than any other Canadian wireless carrier's network, providing texting and, crucially, texting to 911 across millions of square kilometers that just aren't covered by traditional cell towers.
Wow. So imagine being out camping, hiking, or just living in a rural spot, and you can still text for help if needed.
Precisely. It's currently in a beta trial. And interestingly, it's at no cost right now to all Canadians. Doesn't matter which carrier you're with.
Really? Open beta for everyone, that's unusual.
Yeah, seems like a move to showcase the capability.
And what are the future plans? Is it just texting forever? Yeah.
No, they plan to expand it. The goal is to support apps, data, and eventually voice calls, including 911 voice services over satellite. They're estimating that rollout for sometime in 2026. Depends partly on their satellite partners, like Starlink.
Okay, that's definitely one to watch. What else on the innovation front?
Well, they also started deploying 5G advanced network technology. That's another Canadian first. And they highlighted being ranked Canada's most reliable 5G plus network by Umlaut, an independent testing firm.
Bragging rights.
A few, yeah.
Yeah.
And on the home internet side, they were the first Canadian provider to start rolling out Wi-Fi 7 nationally, starting in Calgary and Atlantic, Canada.
Wi-Fi 7. So faster, more efficient home internet, potentially.
That's the promise. All these things, Rogers emphasizes, underscore their 65-year record of investing in Canada, contributing to jobs, GDP, all that.
Right. They invest billions.
But
not all news is good news for their future investment plans, is it?
Yeah.
Especially when we get to regulation.
no, this brings us to a really crucial and kind of contentious point. The recent CRTC decision. The regulator decided to allow the three largest providers, Rogers included, to continue operating as resellers, or MVNOs, on competitors' networks outside their existing home internet footprint.
Okay. And Rogers is clearly sounding the alarm on this one. They're arguing it threatens billions in investment. Big warning. But is there another side to this argument? Like, are consumer groups or maybe smaller players seeing any benefits from this ruling that Rogers might be, shall we say, overlooking?
That's a fair question. Rogers' position is very strong. They argue this decision stifles real competition based on real invested capital. Their view is it effectively provides subsidized access to well-capitalized corporations to use our balance sheet and capital. Basically, why build your own network if you can just ride on ours cheaply?
They feel it discourages building infrastructure.
Exactly. They believe it disincentivizes building out their own networks, which they argue is the real competition. However, from the perspective of smaller internet service providers, the ISPs, and maybe some consumer advocates, this decision could potentially foster more competition, at least in the short term,
How so?
by allowing these smaller players or even other large players outside their home turf to offer services in areas they wouldn't otherwise be able to reach without building really costly infrastructure themselves.
So theoretically, more choice for consumers, potentially lower prices.
That's the argument from the other side, yes. More choice, maybe downward pressure on prices. Rogers, though, counters with that stark warning we mentioned. They're saying, point blank, if this policy stays, it will force Rogers to cut capital programs and with it, network construction jobs. They claim it puts billions of dollars in network investment in our sector at risk. Strong words.
Very strong. So given that very contentious landscape, what exactly is Rogers asking for? What do they want the government or the CRTC to do?
They're explicitly asking the federal government to step in, to lead and direct the CRTC to, in their words, do the right thing for Canada and for our economy.
Which means
Essentially, they want the policy reversed, or at least adjusted significantly to prioritize what they call facilities-based competition.
meaning competition where companies build and own their own networks.
Precisely. Competition driven by companies investing their own capital to build infrastructure.
So this is a really significant regulatory roadblock from their perspective. Could impact future investment, network build-outs, and maybe Canada's overall connectivity goals.
It's definitely a major point of friction right now, yes.
Yeah.
Huge potential implications.
Okay, so finally then, let's look ahead. Rogers' updated outlook for the rest of 2025. After such a, well, transformative quarter, what can we expect from them for the remainder of the year?
Right, they did update their full year 2025 guidance, so total service revenue. They now expect it to grow by 3% to 5%. That's actually an increase from their previous outlook, which was 0% to 3%.
And that bump is mainly because of MLSE being included now.
Exactly. That directly reflects adding MLSE's financial results into the mix. However, adjusted EBITDA growth guidance remains unchanged, still predicting 0% to 3% growth for the full year.
Why wouldn't EBITDA guidance go up too if revenue is?
Good question. It reflects the seasonality of MLSE's business.
Yeah.
Q3, for example, which is coming up, is typically the off-season for major sports teams like the Leafs and Raptors.
Ah, okay. So costs might remain, but major revenue streams are lower in Q3. That impacts the short-term EBITDA contribution.
That seems to be the reasoning, yes. Seasonality smoothing out the immediate impact on the full-year EBITDA forecast.
Makes sense. And what about their spending, capital expenditures, and that all-important free cash flow?
Capital expenditures. They're spending on networks and infrastructure. They expect that to be at the very low end of their guidance range now, around $3.8 billion.
So maybe tightening the belt a little on spending, or just being more efficient. Could that be related to the CRTC thing?
Could be signaling capital efficiency, maybe some caution. They didn't explicitly link it to the CRTC decision in the guidance, but they did flag that issue strongly elsewhere. It indicates a continued focus on managing capital carefully. And free cash flow guidance remains unchanged. $3.2 billion to $3.2 billion for the year. That includes the impact of those distributions to the Blackstone Fund we talked about.
Okay. And overall message.
They reiterate their commitment to maintaining an investment-grade balance sheet. That's key after the Shaw deal and now MLSE, while also continuing to invest in core markets. And they specifically mentioned focusing on the long-term capital funding for that extra MLSE stake.
Yeah.
And on monetizing and surfacing the very substantial unrecognized market value of our sports and media assets.
Right. Back to unlocking that value.
Yep. It's clear they're making these really aggressive moves to reshape their portfolio, speed up their strategic plans, but all while keeping a close eye on the balance sheet.
Okay. Wow. We've just explored a truly transformative quarter for Rogers Communications. That feels like the right word. Touching on their pretty robust financial performance, those huge strategic masterstrokes deleveraging the MLSE ownership, plus the groundbreaking network innovations like satellite texting and that really critical regulatory environment they're navigating. It's a lot to unpack.
Absolutely. It's a complex picture, a multifaceted strategy playing out in real time, for sure.
So here's maybe a final thought to leave folks with. Considering Rogers' really ambitious moves now to diversify, to unlock value in this big sports and media empire, and doing that alongside pushing cutting-edge wireless innovations like satellite connectivity, how might this whole strategic shift actually reshape the core identity of what we think of as a traditional telecom giant? And more importantly, what implications could that have for the future of bundled services, for competition, and ultimately for you, the Canadian consumer?
That's the big question, isn't it? How does a telco evolve when it's also a major sports and media owner? This is really just the beginning of understanding these complex layers, these moving parts. We definitely encourage you to keep an eye on how these big strategic bets play out. It's going to be fascinating to watch.